Hey everyone, and welcome back to the club. This week we're talking about a story that has shaken the world of investing, the potential breakup of Kraft Heinz. Now, if you're a dividend investor, you might be looking at this news and thinking, what does this mean for my portfolio? This isn't just a headline about a corporate split. This is a cautionary tale and a comeback story all rolled into one. It's a drama starring one of the most famous investors in history, Warren Buffett. This story holds the key to building wealth without fear. Because by the end of this video, you won't just have a better understanding of Kraft Heinz, you'll have a simple playbook to help you spot hidden value and red flags in any company. Let's go back to where it all began. In 2015, two food giants came together. Kraft and Heinz merged in a mega deal, orchestrated by Warren Buffett's Berkshire Hathaway and a private equity firm called 3G Capital. At the time, the narrative was compelling. Buffett's legendary reputation for value investing combined with 3G Capital's aggressive, lean and mean management style. The playbook was an extreme cost-cutting strategy known as zero-based budgeting. Unlike traditional budgeting, which simply adds a percentage to last year's spending, ZBB forces every single department to justify every expense from scratch. The idea was to eliminate wasteful spending and unlock a torrent of cash flow. It was hailed as a blueprint for the future of consumer goods. Analysts and investors cheered. Everyone thought they had found a magic formula. But this magic formula failed spectacularly. The human toll was immediate. Within just 5 months of the merger, over 5,000 employees were laid off. This wasn't just about streamlining, it was about gutting the organization. The paperclip culture took over, where even minor expenses were scrutinized. Employees were told to print on both sides of a paper. Office refrigerators were removed. This wasn't efficiency. It was a form of corporate starvation. And what did this mean for the brands? It was a disaster. The 3G takeover was a masterclass in how not to manage brands. While money was being funneled to shareholders, iconic brands were left to wither. Marketing and innovation budgets were slashed to the bone. Think about the brands you grew up with. Oscar Mayer, famous for its wieners and lunch meats, saw its market share dwindle. Maxwell House, a staple in American homes for decades, lost its place on the shelf. The demand for Lunchables, cratered after a major expose, highlighted their high sodium content. And without any R&D budget to reformulate, the brand couldn't respond. This wasn't an isolated incident. 3G Capital's influence on other companies like Anheuser-Busch InBev has followed a similar pattern of prioritizing the bottom line over brand health and consumer connection. A decade later, the ultimate result is clear. The stock is down over 60% since the merger. The company was forced to take a painful $9.3 billion impairment charge. This was a brutal admission that the very brands they had acquired were now worth far less than what they had paid for them. Even Warren Buffett, a longtime advocate for the partnership, admitted in a CNBC interview that he overpaid for the deal. With that failure now in the rearview mirror, let's talk about the red flags and opportunities that exist today. The company is reportedly exploring a new strategy. This is not just a strategic decision. It's an act of survival. This is a powerful lesson for us as investors. We need to look beyond the headlines and the promise of a big merger. We need a playbook to spot the red flags and the hidden opportunities. The first red flag is a powerful but often misunderstood metric called the Altman Z-score. Developed by NYU professor Edward Altman, this formula is designed to predict the likelihood of a company filing for bankruptcy within 2 years. So, why is this important for you? The Altman Z-score is made up of 5 key ratios that tell a story about the company's health. It starts by measuring short-term liquidity to see if a company can pay its immediate bills. It then looks at retained earnings to see how a company has funded its growth, with a low number here suggesting reliance on debt. Next, it measures EBIT to total assets to show how efficiently the company's assets are generating a profit. Then it examines the market value of equity to total liabilities, which is a measure of leverage, suggesting if the market has lost confidence due to too much debt. And finally, it looks at sales to total assets as an efficiency ratio to see how well a company uses its assets to generate sales. Kraft Heinz's low score was a warning that the company's aggressive debt load, combined with stagnant sales and brand impairment, was a recipe for financial trouble. This is the kind of deep dive you must do as a confident investor. For a dividend investor, a company's dividend history is its most sacred promise. A cut to the dividend is the ultimate betrayal. At the time of the merger, Kraft Heinz had a quarterly dividend of 57 cents per share, which was an attractive draw for investors. However, in 2019, the company slashed the dividend by a shocking 36%, from 62 cents to 40 cents per share. This was a clear signal that the company's cash flow was simply not enough to cover its debt and its dividend obligations. It was a painful moment for income investors. The lesson here is that a high dividend yield can be a dividend trap if the payout is not supported by strong free cash flow and a healthy balance sheet. Now for the good news. While the Z-score is a serious red flag, there is a powerful contrarian signal here. The company's price-to-sales ratio is near a 5-year low. This metric compares a company's market value to its total revenue. Why is this important, especially for a company like Kraft Heinz? When a company is not consistently profitable, its PE ratio is useless. The PS ratio, however, gives us a baseline valuation. A low PS ratio suggests that the market is valuing the company's sales at a historically cheap level. The company recently reported better than expected quarterly results. It's not explosive growth, but it shows management's new strategy is gaining traction. Organic net sales, which strip out currency and acquisition impacts, are starting to improve. This shows the core business is more resilient than the headlines suggest. This is a classic sum of the parts theory in action. The company is a mess, but its individual pieces might be worth more than the whole. We are now seeing the logical next step. The company is reportedly exploring a strategic split. The plan is to split the company in two, creating a clearer business identity for each. First, the new Heinz. This company would be a pure-play growth stock, focused on a portfolio of faster-growing global brands. This would include its famous Heinz ketchup, as well as sauces like Grey Poupon. Its competitive landscape would be fierce, fighting for market share against international powerhouses like Unilever, Nestlé, and even beverage giant PepsiCo, which has a strong presence in condiments and snacks. This new entity would likely have a higher valuation multiple because of its global growth potential. The new Kraft, on the other hand, would house the slower growth but stable grocery portfolio. These are the legacy brands, the comfort foods like Oscar Mayer, Jell-O, and Capri Sun. This new entity will be a formidable player in the North American grocery business, competing with other giants like General Mills, Mondelez, and Campbell's. This business would likely appeal to income-oriented investors, with a focus on stable cash flow and dividends. This split is a dramatic move. But from a dividend investor's perspective, it's a bold way for management to address the core problems. It cleans up the messy financials and focuses on distinct business lines. It also directly addresses the Altman Z-score by potentially restructuring the debt to better fit each company's cash flow profile. For the dividend investors, you may ask these two questions. First, will my dividend be safe? The company has publicly stated it is placing high importance on protecting its dividend and its investment-grade status. The split is an attempt to create two healthier companies, which could make the dividend even more secure in the long run. Next, what are the tax implications? Most corporate spin-offs are structured to be tax-free for shareholders, under U.S. Tax Code Section 355. This means you would likely receive shares of the new company without having to pay a capital gains tax immediately. However, it is crucial to consult a tax professional. This is not a buy or sell recommendation. This is a framework for thinking. The Kraft Heinz story, with all its failures and potential for a comeback, gives us a powerful playbook for confident investing. The Kraft Heinz story gives us a powerful playbook for confident investing. First, we learn not to fall for financial engineering. The merger was a masterclass in this. But as investors, we must remember that cutting costs and slashing jobs is a short-term fix. A great company is built on brand strength, innovation, and a healthy corporate culture. Second, and just as important, is to use a variety of metrics. Don't just look at dividend yield, look at the balance sheet. A healthy dividend can be a red herring if the company's in financial distress. And the Altman Z-score is an indispensable tool for spotting a broken company. Third, understand corporate events. Actions like splits are not just headlines. They are a sign that management is aware of deep-seated problems and is taking dramatic action. And understanding the logic behind the split can help you find value where others see only risk. And finally, the most important lesson of all is to embrace patience. The market will react to headlines and it will overreact, but a confident investor understands the underlying business story. This is a story of a company laying down roots for future growth after a long, hard winter. The story of a company, just like a tree, isn't defined by a single bad season. It's defined by the slow, deliberate work of laying down roots, strengthening its core, and preparing for future growth. The Kraft Heinz saga proves that patience and an understanding of fundamentals can uncover value where the market sees only a broken company. This is what it means to be a confident investor. And if you want to become a more confident investor, make sure to hit that subscribe button so you don't miss our next video. If you found this video helpful, please give it a thumbs up to help others discover it. And let us know in the comments below, what is your biggest takeaway from the Kraft Heinz story? Your questions help us make better videos for you. Thanks for watching.